Hello, everyone. Welcome to our tax planning webinar today. I'm so happy that you could be a part of this webinar because we're going to talk about some really important topics today. At the very end of the webinar, we will be doing a Q&A, so any questions we will be answering at the very end. But the big focus today, you can see our agenda list on the PowerPoint. So first, we are going to touch on underpayment penalties, specifically for taxes. So we will talk about kind of what triggers those, how they are calculated, things you can do to avoid them. But the main topic of discussion is really going to be surrounding IRS Form 2210. This is a form that you can use if you have income that really just fluctuates. Maybe it's not the same every single quarter. So we will definitely dive deep into that. And then lastly, we'll talk about some strategies that you can implement to reduce your taxable income. It's going to focus more so on, if you have a lot of income and you're looking for some pretty large deductions on how you can do that. So first, we are going to touch on really just understanding the underpayment penalties for your taxes. So the IRS uses a pay-as-you-go system. It's not necessarily, everything is due April 15th. While that is true, timing really does impact these penalties. So taxes do have to be paid as income is earned throughout the year. If you underpay in certain quarters, even if you catch up later and you cover your whole tax bill by April 15th, you still could potentially face some type of underpayment penalty. So the general rule of thumb is that if you owe less than about $1,000 after you account for any withholdings and any credits, then you're typically not subject to any penalties. You can just pay that tax due outright. But normally when you owe more than $1,000, that's typically when the penalties do kick in. So the IRS does have some safe harbor thresholds. So in order to avoid a underpayment penalty on your taxes, you typically have to pay the lesser of 90% of your current year tax liability or 100% of the prior year tax liability. And there is a special rule. So if you made more than 150 grand, specifically if your AGI was over 150 and you are a married filing joint filer, then in order to avoid that penalty, you do have to withhold about 110% instead of 100 for the prior year. And the interest rate that is used for this penalty, it does change year to year. So last year, for example, it was about 8%. I believe in 2025, that penalty is closer to 7%. So again, it does gradually change a little bit every single year. And I did want to walk through an example about how these penalties are really calculated. And this is more so going to focus on how the timing of your estimated tax payments can still incur a penalty. So in this example, let's just assume that a taxpayer owes $20,000 in the current tax year. Well, if we use those IRS safe harbor rules that we just looked at on the previous slide, we know that we have to, through withholdings or estimated tax payments, we know that we have to have paid 18 grand, by April 15th, in order to avoid any type of penalty. Now, let's say that quarter one, two, and three, let's say that you made an estimated tax payment of about $1,000 per quarter. And then maybe in quarter four, maybe you just had a lot of income, maybe you're self-employed. And so you just make one really large, last quarterly payment in January. Well, the IRS assumes that your income is spread out evenly during the year and during the quarter. And so that's also how the IRS expects you to actually make those estimated tax payments. So, with that being said, this means that this person really should have made payments of about $4,500 every single quarter, opposed to, splitting it up, how this was. So if we assume that average underpayment interest rate of about 8%, which is 2% per quarter, that total penalty would come out to about $210, which I know 210 isn't maybe, a ton to owe in a tax year, but say you already owe because maybe you under withheld or you just underpaid, then to have a penalty, slapped kind of right on top of that, you could potentially end up owing more than you really want to. And that brings us into IRS Form 2210. We're specifically going to focus on Schedule AI. Schedule AI is a part of the Form 2210. So we will go through an example today and kind of give you a better idea of really how this form is used. But like I said, the IRS assumes that your income is earned evenly throughout the year. And that's why, IRS Form 2010 would be used, because that form basically will show why you shouldn't be penalized for underpaying if your income is not even throughout the year. So somebody who would use this form, if you're self-employed, so you own your own business, maybe quarter one, two, and three, maybe those are your slower quarters during the year. And then maybe, quarter four, you get to Christmas and the holidays. Maybe you just have a lot of income coming in during that last quarter. So somebody in that situation, I think, would benefit from using this form. Really, just anybody who has a lot of fluctuating income, I think, could benefit from using this form. So, a couple other things, any taxpayers with passive income, for example, maybe some rental income. I know rent stays pretty consistent, month to month. Or if you are a commission-based professional, obviously your income can fluctuate a lot there. So like I said earlier, even if you've paid enough overall throughout the year, when the income was earned really does matter. And I also do want to point out that this doesn't affect W-2 employees really as much, because the IRS, if you're a W-2 employee, does assume that your income and your withholdings are basically even throughout the entire year. So this really pertains more so to maybe somebody who would receive a 1099, for example. But using IRS Form 2210 with Schedule AI really helps align your estimated tax payments with when your income was earned to reduce or eliminate any penalties. That's basically the purpose of the form. So again, somebody who does have consistent income probably would not need to use this form. And the IRS is just going to assume that your income is equal every single quarter unless you tell them. So the IRS is never going to, reach out to you if you were penalized for underpaying or not paying enough in certain quarters. They're still going to charge you that penalty. So that's also why you do need to utilize this form to kind of let them know that your income was different throughout the entire year. But Schedule AI lets you report your income based on when it's actually earned. And I will pull up the form here in a couple minutes, and I do want to walk through an example. So we will do that here in a minute, but the basics of how Schedule AI really works is you will enter your actual income, every single quarter on this form, and you will annualize that quarter's income based on a rate provided by the IRS. You will then calculate the tax owed based on, your estimated annualized income, and then you will actually compare that to what you paid in taxes. So I definitely do recommend working with a CPA if this is a form that you are interested in. The form's only about 3 pages, but it is a little more on the complex side. So, you know, definitely work with the CPA so that they can make sure that this is filled out, 100% correct. Because again, they'll be very familiar with this form. So I'm going to pull up this screen here and just kind of give you an overview of this form. So this is Form 2210. Again, there are about 3 pages to this form. Um, Again, I'm going to focus on Schedule AI today mostly, but page 1 basically takes you through a little bit of a questionnaire for if you even have to or if you qualify to use this form. So you can see that one of the first questions it asks you is if you owed less than $1,000 on your tax return. And obviously, um, if you if you owed less than $1,000, then you wouldn't really need to complete this form. But if you owed more than $1,000, you would need to complete this form to avoid that penalty. But your CPA will fill all that information out. You won't really have to worry about that. But I think that this example will give a better idea of how this form really works. So this is form Schedule AI. So I'm just going to go over this example I've formatted out here. And so step 1, you can see that there's 4 columns here with all these different time periods. So column 1 is focusing on January 1st to March 31st. And row 1 just wants you to put down your income for that specific time period. So obviously in quarter 1, this person earned about $10,000. Now, by the end of quarter 2, so May 31st, this person had made about 15 grand in total for the year. It's not 10 grand quarter 1, 15 grand quarter 2. It's just 15 grand for this specific time period, so Q1 and Q2. So we know that this person earned 10 grand in Q1, and then somewhere in Q2, they had to have earned about $5,000. And then we obviously do that for column 3 and 4. So you can see that column 4 this person has made about 120 grand by the time we get to December 31st. So we know, we don't know what this person's profession is, but we do know that most of their income had to have occurred in quarter four because by the end of August 31st, this person had only made 30 grand for the year. So this is a good example of, kind of why somebody would use this form. After you have your income numbers laid out, you are going to multiply it by whatever annualization amount that the IRS has right here. So first column, 10 grand times 4 because we still have 3 more quarters left in the year. So this is proving to the IRS that, based on what I made quarter one, this is what I think I'll make by the end of the year. And, essentially, this is why I shouldn't be penalized. And then we do the same thing for column 2. These multipliers go down, you can see as time goes on, but that's because by the time we get to, May 31st, we don't have 3 more quarters left in the year. The year is half over. So that multiplier does go down. Once we get to the end of the year, we only multiply by 1, obviously, because we're at the end of the year, so we know that that is our true income amount. A couple other things I do want to note before I go on. This is a 2024 tax form. The 2025 version will not come out until early 2026, like during tax season. And then for this example, I am going to assume that this person is taking the standard deduction and not itemizing. I just think for simplicity purposes, that would be easiest. But for line 4, 5, and 6, this is specifically for your itemized deductions if you do that. So kind of similarly to what we just did with the income, where we annualized those income numbers, if you take itemized deductions, you would do the exact same thing. Just put your itemized deduction amount for, whatever time period we are looking at, and then multiply it by this annualization factor. So basically, again, what we just did for income, but for an itemized deduction. So for this example, we are just going to put 0 for line 4 and line 6. Now, since I am using a 2024 tax form, I'm also going to use the 2024 standard deduction. So for line 7, we basically just put the standard deduction. We don't have to annualize this standard deduction because it already is annualized. So we don't need to multiply it by anything, basically just copy and paste right across the row. Line 8, we would input the larger of the standard deduction, or if you itemize, we would have used whatever is on line 6. But again, we are just using the standard, so we basically just move all these numbers from 7 down to row 8. For line 9, this is for a qualified business income deduction, which for this example, we are just going to assume they get a QBI deduction of about 5 grand. So again, that number's already annualized. We don't need to do anything to it. So we are just going to copy and paste that across every single column. Line 10 is where we actually add up our deductions. So we are just adding the standard deduction and then the QBI deduction. So that equals 34,200. Now, line 11, this is where we are going to subtract that annualized income number. So if we're looking at column 1, we would take 40 grand less that standard deduction and QBI deduction. So essentially, line 11 is kind of showing your taxable income. The taxable income is the amount you actually get taxed on. You don't actually get taxed on the 40 grand or, the full 120 grand because that's before deductions. So we have to subtract deductions first to figure out how much tax is owed. So for quarter one, we assumed taxable income was going to be about $5,800 for the entire year. But you can see that when we get to May 31st, now we're like, oh, it might be closer to $1,800. Well, that is because if we scroll back up, that is because we just made a lot less income in quarter two compared to quarter one, and so our income was lower. Therefore, our taxable income was a lot lower. And we'll just do the same thing for column three, which again, this represents January 1st through August 31st. And then we will do the same for quarter four, which quarter four is going to be the most realistic because we're at the end of the year, so we know what our income is. Line 12, this is specifically for estates and trusts. So if this is a form you could see yourself using in the future, you probably will not even be filling out line 12. So we're just going to put zeros there. Line 13, we're basically just moving down whatever's on line 11, so those taxable income numbers, and just copying those just as we had on line 11. So no changes there. Line 14, we are actually going to figure out the tax owed on whatever income amount we have. So you can see that at the end of Q1, that minimum amount that we roughly would have to pay to avoid any type of penalty or, excuse me, total tax owed would be about $583 if we made $5,800, $181 if we made $1,800. But you can see by the end of the year that we know we should have paid in total somewhere around $9,859, or that's the amount we will owe. Line 15, this is for self-employment tax, which again, for simplicity purposes, we are just going to put zero here. Line 16, this is going to be for an additional Medicare tax or net investment income tax, which again, we're just going to keep things simple and put zero across the board. Line 17, we are just going to transfer down the total taxes owed at the end of each period. So just copying those down here. Line 18, this is where you would input any credits that you would have. We're just gonna, again, use zero to make things easy. So line 19, we basically just copy, what we figured our tax would be based on these income numbers above. And then we multiply this by an applicable percentage. And this is basically showing like, hey, I need to have paid maybe this amount this quarter or maybe by the end of the year to avoid any type of penalty. Because you can see once we get to quarter four, we know that we would have had to have paid at least $88.73 to avoid any type of underpayment penalty. So that is how Schedule AI basically shows the IRS that your income was different in every single quarter. There's more things that you can fill out. I'm not going to go into all of this today. I feel like this section of Schedule AI really does show the gist of how this form works and why you would need it. So this is what your CPA would need to elect to use to prove to the IRS that you shouldn't be paying a penalty because your income was fluctuating. So a couple more things that I just do want to touch on. I mentioned that you do have to elect to use this form. Even if you qualify, it's not something that's automatically applied. So definitely bring it up to your CPA if maybe he or she hasn't talked about it before. Um, this form can be filled out, right when you are filing your taxes and you send your return in, or you can use it proactively during the year to track what you should be paying in estimated tax payments. So this isn't something that you have to use the entire year before you even pay or file your taxes. You can if you want, but really just make sure it's filed with your return. Now, if you did already file this year and if you were penalized, you can amend your return to include Form 2210 to reduce or eliminate that penalty. So next, I just want to talk about some strategies you can utilize to reduce your taxable income. Again, this is kind of going to gear a little more towards if you have a lot of fluctuating income, or maybe it comes in very large amounts and you're just looking for some larger deductions, things that you can do. These are just some ideas that you can bounce around. So the first strategy, it's very simple. I have a couple slides over strategy number one. So slide two will focus more so on if you are self-employed, what does that look like? But this slide is going to focus for really anybody, W-2 employees, or if you are self-employed. But so the first one is just maxing out retirement contributions, and I'm focusing on 401k and 403b plans because these are just the most common types of plans out there. So the most you can put into these types of plans is $23,500. This number does typically change a little bit every single year. So that's just the limit for 2025. Now, if you are 50 or older, you can do what's called a catch-up contribution for an additional $7,500. So that would make the total contribution 31 grand. Now, a couple new rules. Number one, this just started, I want to say last year, maybe this year, but if you are between the ages of 60 to 63, that catch-up contribution jumps from $7,500 to $11,250. So obviously, whatever you put in a pre-tax 401k or 403b, that amount is not included in income, which is why it's a tax advantage now. But starting in 2026, this is a new rule. So anybody who made 145 grand or more in the prior year 2025 will have to put all of their catch-up dollars in a Roth 401k or Roth 403b. Roth accounts are after tax, so you don't really get that above the line tax deduction like you do with a traditional or a pre-tax 401k 403b. But when it comes to somebody who is self-employed, you can actually open up what's called a owner's only 401k, also called a solo 401k. There's really only one qualification, and that is you can only have one employee. However, if you have two, the second one can be your spouse. So that is an exception. But what's really nice about a solo 401k is that you can contribute as an employee and an employer. So, employee and employer, the most you can contribute together is the lesser of $70,000 or 100% of your salary. Again, whichever one is smaller. So, since you can act as employer, $70,000, that's a lot of income that you could potentially exclude from your tax return and being taxed. So I think that's a huge advantage for self-employed individuals. Something else that's really nice is that employer contributions are actually not due until the business's tax filing deadline, and that does include extensions. So employee contributions, those are due December 31st, but as employer, you have up until your tax filing deadline, in case you just need some more time to kind of gather money for that contribution. Strategy number two is about accelerating itemized deductions. And the biggest itemized deduction here is going to be the charitable giving, which we will focus on second. But this specific strategy will not work if you use the standard deduction. So this is only if you actually itemize. But the first deduction you can accelerate. So property taxes and then state and local taxes. So the state and local taxes, those the final payment is due in January 15th. So you can prepay in December to include that as an itemized deduction for, that current tax year. The downside is that the deduction is, as of right now, limited to $10,000. I know that the tax bill that I believe was passed either yesterday or today. I want to say the last thing I saw was that it raised this deduction limit to 40 grand from 10, but I'm not 100% certain. So there should be more information on that in the future, but that would be very, very helpful if that was the case. Now, the second strategy, if you are charitably inclined and you consistently do give to different organizations, you can use something called a donor advised fund. Now, this is an account. And, let's say that there's a specific organization that you give to every month or every year. And let's say you know that you are going to have a lot of income this year. Let's say you always itemize your deductions, but you really need some more deductions to lower your income. You can you can put into this type of an account 2, 3, 4 years or more worth of your charitable gift giving, whether that is money or it's stocks, whatever you want. You can basically bunch your future gifts into one account and you receive an immediate tax deduction. You don't have to deploy this money, as soon as it goes in the account. You can kind of pick and choose when you want to deploy money to, whatever organization. But once the money goes into the account, it is then earmarked specifically for charity, but you get that immediate deduction. Now, if you're just contributing cash, that deduction is limited to 60% of your AGI. If you are giving non-cash, so things like stocks and bonds, that deduction is limited to 30% of your AGI. So obviously cash would give you a much higher deduction amount. And then another idea, this is going to be specifically if you are self-employed and you own your own business, is you can accelerate and deduct prepaid business expenses. So some examples are like rent, insurance, business licenses, and fees. But this typically really only works for cash basis taxpayers. So if you utilize an accrual base of accounting for your business, this won't really apply to you. But if you are cash basis, then you could qualify for the 12-month rule. That basically just means that any expenses you have prepaid within that calendar year, you could bunch up together and accelerate that deduction, as long as the gain from that benefit doesn't last more than 12 months from the date the benefit begins or the end of the tax year, which the payment is made, just whichever one's earlier. So that's another option, but I definitely think out of these three, the charitable, the donor advised fund would be the most helpful by far. And then one last strategy. So this is probably going to provide the lowest deduction amount out of everything that we have talked about, but you can contribute to 529 plans. 529 plans are strictly education accounts. So your kids or your grandkids might have some set up, but 529 plan contributions, first of all, they only reduce your state income taxes. Unfortunately, they don't reduce federal. And for 529 plans, so every state does have their own 529 plan. So to get that state's tax deduction, you do have to be a resident. And the 529 plan does normally have to be like that state's specific plan. So for Ohio residents, the state tax deduction is $4,000 for Ohio 529 contributions per beneficiary per year. The most that you can contribute to a 529 plan is $19,000 per beneficiary, and that is because contributions to a 529 are considered a gift, so there's just some limits there. But what is nice is for Ohio, any excess contributions over that $4,000 amount can be carried forward into future tax years until all the contributions are fully deducted. So if you contribute a pretty large amount, you don't just lose that deduction, it is carried forward basically until it is used up. All right, so just a couple other things before we wrap up here. All of my blog posts are on our website. And then you can always use this URL to kind of access those blog posts. There will be a search bar on our website. If you do have a specific topic that you are looking for, that will be really easy to find on there. And then if you want to receive any updates for any new posts that come out, they do come out every single month. You can just email this email address up here with your first and your last name to get access to those posts automatically every single month. But if you have any questions, you can always reach out to us. Again, would recommend working with a CPA for any of these topics, but I hope that this was very helpful, and thank you for those who did attend.